Assalamualaikum and good day everyone. My name is Hakim Muhammad Hamzah and my metric number is 252602. Today our group will be presenting on topic 8, accounting for aviation industry. Our content of presentation consists of 5 parts, which is nature of activity, aviation industry in Malaysia, accounting issue in aviation industry, presentation of financial statement and question and answer. And now I proceed on first part of our presentation, which is nature of activity. First of all, what is aviation industry? Aviation or airline is a company that provides air transport services for traveling passengers and goods. It will use aircraft to supply these services and may form partnership or alliance with other airlines for codeshare agreement. So, codeshare agreement is a business arrangement commonly used in aviation industry where two or more airline companies will publish and market the same flight under their own airline designator and flight number. The example of codeshare agreement in Malaysia is an agreement between Malaysian Airlines and Qatar Airways. And airline companies are recognized with an air operating certificate or license issued by a governmental aviation body. And in Malaysia, it is licensed by Civil Aviation Authority of Malaysia, CAAM. It is responsible to safeguarding civil aviation operation in the country, exercise safely regulatory oversight of the civil aviation, and regulate the operation of aviation services and facility in Malaysia. Due to the robust demand for international air travel, is making Malaysia an important region for connecting flights. Hence, KLIA and KLIA2 have been ranked the world number 12 in airport connectivity in 2019 survey by Air Flight Data Organization (OAG). And we'll move on to the second part, which is aviation industry in Malaysia. Commonly, aviation airline that we know in Malaysia is AirAsia, Nation Airline, Manindo Air, and Firefly. So this is the comparison on fleet size and destination between this airline company. As we for your information, fleet size is the refer to the number of plane or aircraft of similar model operated by an airline. So we can see here that AirAsia have the most number of fleet size and destination compared to other airline company. AirAsia, so we can say that AirAsia is the major and the leading airline company now in Malaysia, and it also can be proven by the percentage of market share. And for AirAsia, for 2018, it has 15% of market share compared to the other company. And also we can see that from annual passenger traffic, AirAsia have the most number in 2018, and another year also, it has the most annual passenger traffic. And beside passenger airline, aviation industry in Malaysia also have cover on charter airline that provided by Berjaya Air, MH Aviation, Sabah Air, Western Aviation, and Layan-Layan Aerospace. And lastly, we also have a cargo airline that based on Malaysia that provided by Asia Cargo Express, Mas Cargo, Raya Airway, and MyJet Express Airline. That's all from me. Thank you.
And I'm Nabila Najmi. My metric number 256748. So I will continue to present about accounting issues in aviation industry. So there are two issues in aviation industry. The first one is revenue recognition and also list of aircraft. So for the revenue recognition, it will cover on revenue from passenger, revenue from freight services, and also the other income sales of loyalty point breakage. The second one is list of aircraft, which is cover on finance lease, operating lease, and also sales and leaseback transaction. So let's see for the first one, which is revenue recognition. So for the revenue recognition, revenue is measured on the basis of the consideration provided in a contract with a customer based on revenue recognition policy of MFRS 15, revenue from customer with contract. So revenue is recognized when or as it transfer control over a product or service to customer. And the amounts of revenue recognized is the amounts of allocated to the certified performance obligation. So for the performance obligation, it will be certified either over times or at a point in time. So for the performance obligation certified over time, an entity recognizes revenue over time by transferring goods or service to a customer if any below criteria is met. So either the customer simultaneously receive and consume the benefit provided by the entity performance as the entity perform, or the entity performance create or enhance an asset that the customer control as the asset is created or enhanced, or the entity performance does not create an asset with an alternative use to entity and the entity has an enforceable right to payments for performance complete to date. So if the performance obligation is not certified over times, so an entity will certify the performance at a point in time. So the next one is about type of revenue in airline industry. So in airline industry, there are two types of revenue, which are revenue from passenger and also revenue from freight services. So I will going to present about revenue from passenger. The other one, the revenue from freight services, will be present by my friends. So for the first type of revenue in airline industry, which is revenue from passenger relate to the scheduled passenger flight and charter flight income. So it is normal practice that flight tickets are sold in advance to the actual flight date. Initially, all the ticket sales are recognized as sales in advance, which is presented as a current liability. So revenue from the passengers is recorded when the air transportation service is provided. So it is recorded at its selling price and net of discount and included the related ancillary revenue such as airport and insurance surcharges, maturity fees, baggage fees, assigned seat, and also the other related costs. So if there is any contract modification and add distinct goods or services, it should be counted as a separate account. For example, additional charge for airport, shuttles transportation services.
So I will proceed with the revenue from freight services. This type of revenue is quite similar with the revenue from passengers. The only distinction is by delivering services and delivering goods. So for freight service is for delivering goods. And the recognition for this type of revenue is similar with the freight from revenue from passenger, as it recognized as sales in advance and presented as current liabilities. So the revenue is recorded when the air transportation is provided, which is the performance obligation, and the price, it is recorded at its selling price and net of discounts and includes ancillary revenue. So next is the revenue from other income. So in this revenue, there is customer loyalty program, which is, for example, like Asia, they have this big member, which is we need to sign up to redeem points when we purchase the tickets to fly over to places we want to go. So the members collect points from purchases made, then they are entitled to receive discounts for future purchases. And then the revenue from the points is recognized as deferred revenue when using the points and recognized as revenue when it is redeemed. So the amount of revenue recognized is based on the number of points redeemed. Redemption value of each point is calculated on a weighted average basis. And then the revenue is associated with sale from merchant partners under this program is recognized when the obligation is complete. So for the customer loyalty program, they may have some points that are redeemed and some may not. So this is when the company will estimate the loyalty points that are expected won't be redeemed by customers. That is the breakage. The estimation is based on the terms and conditions of membership and historical accumulation and redemption patterns. And so there is a deferred breakage which is included in the trade and other payables. So the amount of revenue recognized based on the points redeemed in relation to total of number expected to be redeemed.
Proceed to the next part, which is lease of aircraft. So basically, lease is a contract where owner of the asset, which is lessor, provide the lessee with the right to use of the asset in return for a payment for a great period of time. And there are two types of lease, which is the first one is finance lease. So generally, for finance lease, the lessee will own the asset at the end of the lease term. So leases of asset where lessee will have substantially all the risks and rewards of ownership. Next, for the recognition in the financial statement, lessee should capitalize an asset at the lower of fair value of asset and recognize the liability at the present value of the minimum lease payment. And the basis of accounting would be like this. And then each lease payment is allocated between the liability and finance lease charge, which will be charged to the profit and loss account. Also, lessee should charge the depreciating expense related to the assets held under the finance lease over the shorter of the useful life of the assets and the lease term. And now proceed to the next part, which is operating lease. So generally, the asset still owned by the lessor at the end of the lease term. So leases of asset where a significant portion of the risk and rewards of ownership are retained by the lessor. So in this type of operating lease, there is no capitalization of assets in the balance sheet. Because of that, the lessee will just recognize the lease payment as expense in the profit or loss over lease term on a straight line basis. Next is a sale and leaseback transaction. In this sale and leaseback transaction, it involves the sales of an asset and leasing the same asset back. So in this situation, it means a seller will become a lessee and buyer will become a lessor. When a sale and leaseback results in a finance lease, any gain on the sale is deferred and recognized as income over the lease term. Any loss on the sale is immediately recognized as an impairment loss when the sale occurs. While if the leaseback is classified as an operating lease, then any gain is recognized immediately if the sale and leaseback terms are demonstrably at fair value. And proceed for the last part, which is the changes from MFRS 117 to MFRS 16. Under MFRS 16, it set out the principles for the recognition, measurement, presentation, and disclosure of leases and requires lessee to account for all leases under a single on-balance sheet model, similar to the accounting for finance leases under MFRS 117. It means that there will no more classification of operating lease in the new standard, so no more off-balance sheet financing. It is where lessee is required to recognize assets and liabilities for all leases with term of more than 12 months unless the underlying asset is of low value. For MFRS 16, will applies a right of use approach which requires a lessee to recognize asset and liabilities for the rights and obligations created by lease contracts. So this approach reflects that at the commencement date of a lease, the lessee obtains right to use the underlying asset for a period of time, and lessor makes the underlying asset available for the use of the lessee. So no longer distinction of finance lease and operating lease. So the treatment is similar to the accounting for the finance lease like I mentioned before. And for example, is airline entities and shipping entities that currently treat rental of airplanes and ships as operating lease would be required to recognize the airplanes and ships as right of use assets and corresponding lease liabilities in the statements of financial position. That's all from me. Thank you.
My name is Nur Kairunisa Aiman with Muhammad Nasiruddin, matrix number 252593. So I'll continue the presentation to present about the presentation of financial statement. Okay, first, alright, so this is an illustration of a statement of profit and loss for an airline company. So basically, there is not much difference from other presentation of profit and loss. The difference is only on the some of the items like aircraft fuel expenses, maintenance and overhaul, aircraft operating lease expenses, stuff like that. So next, we'll look at the illustration of a statement of financial position for an airline company. Right, so this is also not much difference. We have additional of like deposits on aircraft purchase, aircraft maintenance reservations, and so on. So you can have a look later on. Okay, next, we'll continue to the next section, which is the self-assessment questions. Right, so the first question is, name two main operators of airline company in Malaysia. So in Malaysia, we have two main operators, which is Malaysia Airlines and AirAsia. And next is, the second question is, a customer bought a flight ticket from Alostar to Kuala Lumpur on 1st March 2019. So the flight ticket is scheduled on 30th March 2019. So the customer paid using credit card for the following items. Ticket price is 250, airport and insurance surcharges is 50 ringgit, administrative fees is 10 ringgit, and pre-assigned seat is 15 ringgit. So we need to explain briefly how and when should the airline company recognize the revenue from the sale of flight tickets to the customer. So on 1st March 2019, the company cannot register the income yet, which is the total of 250 plus 50 ringgit, plus 10 ringgit, and plus 15 ringgit. So we'll get a total of 325. So the company cannot register this 325 as revenue yet, since the company did not yet provide the service. So the company will record this amount under liabilities on the balance sheet in the unearned revenue account. And then on the 30th March 2019, let's say the customer did use the service. So when the service is provided, the company can record the sale of ticket as revenue from passenger. So the unearned revenue account will decrease and revenue from passenger account will increase. And then we will need to explain the differences between finance lease and operating lease. So the first difference is on the title. So in the finance lease agreement, ownership of the property is transferred to the lessee at the end of the lease term. But in operating lease agreement, the ownership of the property is retained during and after the lease term by the lessor. And the next is the option. So in finance lease, the lessee has option to purchase the equipment at the end, but under operating lease, the lessee had no such option. And then the last difference is running costs and administration. So under an operating lease, all running costs such as servicing, registration, insurance, and etc. are included in the lease within the designated term and usage. But under life finance lease, these are generally not included, meaning that there can be a greater administration and price fluctuation for the lessee. And lastly, the last question is, in your opinion, why does IFRS or MFRS move from off-balance sheet financing to on-balance sheet financing for leasing? So, first of all, we need to know what is off-balance sheet financing. So, off-balance sheet financing is an accounting practice whereby a company does not include a liability on its balance sheet. So, the previous standard, MFRS 117, differentiated the accounting treatment between finance lease and operating lease arrangement. So, while finance lease were duly accounted for on the balance sheet, operating leases under MFRS 117 did not necessitate capitalization of lease assets as well as the recognition of the corresponding liabilities by lessee. So in hindsight, this seemingly simple treatment proved undesirable as it not only lacked adequate transparency but also enabled off-balance sheet financing practices to proliferate. So an example of this is that this can be proved from IASB statement that said the listed companies using IFRS or US GAAP disclose almost US $3 trillion of balance sheet lease commitments in 2014. So in my opinion, this is the reason why IFRS or MFRS move from off-balance sheet financing to on-balance sheet financing to prevent this thing from happening. And that's all from me. Thank you.